Ladies and gentlemen, stop looking at the price. No, seriously, stop looking at the price on your screen. Because the price is the least important thing that happened. Let me ask you a question. What if the silver market you think you're watching doesn't actually exist? What if the charts are fake? The volume is fake. The liquidity is fake. And what you're really witnessing? Is there a live bank war happening in silence while retail investors are quietly erased? Because here's the uncomfortable truth. Deutsche Bank was forced to deliver physical silver it didn't want to give up. JP Morgan quietly absorbed nearly 80% of available supply. And retail? Retail got nothing. Gone. No alerts, no headlines, no emergency meeting on CNBC, just disappearance. And if you're feeling inflation right now, if your money buys less food, less fuel, less freedom, if you're working harder just to stay in place, this story is why. Because silver isn't just metal. Silver is trust. Silver is settlement. Silver is what remains when confidence dies. And the system knows it. What if I told you this wasn't an accident? What if this was planned decades ago, hidden behind derivatives, exemptions, and regulatory loopholes? And what if I told you this was the last chance retail ever had to own real money before the door slammed shut? Before we go any further, quick check-in. Where are you watching from right now? Drop it in the comments. Because this isn't just history, this is a global event. And if you want the unfiltered version of what's really happening, subscribe now, because once you see this, you can't unsee it. To understand today's silver war, we need to go backward. Not last year, not to 2008, but to a time when money meant something. Silver was money before banks were power. For over 5,000 years, silver wasn't an investment. It was a settlement. Empires rose and fell on it. Taxes were paid on it. Armies marched because of it. And here's the key point most people miss. Silver restrained power. You couldn't print it. You couldn't fake it. You had to own it. Sound familiar? Because today, governments can print currency infinitely, but they still can't print silver. That's the problem. The first great separation, paper from metal. Fast forward to the 20th century. Banks realized something dangerous. If people ever demand physical settlement at the same time, the system collapses. So they invented paper claims, certificates, futures, unallocated accounts, more claims than metal. Sound familiar? This is the same playbook used in 1929, margin and leverage, 1971, gold window closure, 2008, mortgage derivatives, different asset, same lie. COMEX, the casino disguised as a market. The COMEX wasn't designed to deliver silver. It was designed to price silver without delivering it. Over time, 1 ounce of physical silver backed 100 plus paper claims. Delivery became optional. Cash settlement became the norm. And retail was told, don't worry, it's all regulated. Sound familiar? Enter Deutsche Bank. Deutsche wasn't just a bank. It was a derivatives monster. By the mid-2010s, trillions in notional exposure. Deeply embedded in precious metals, derivatives, heavily short silver. Why short silver? Because rising silver signals currency distrust, and banks cannot allow that. The trap was set. Retail bought paper ETFs. Banks accumulated physical. Prices were suppressed. Confidence stayed high. Until one thing changed. Delivery was demanded, and suddenly, the illusion cracked. Sound familiar? Something happened behind closed doors, a moment the public was never supposed to notice. Deutsche Bank, cornered, over-leveraged, and bleeding credibility, was forced into physical delivery. Not cash, not rollover, not paper, real metal. At the same time, JP Morgan, already the largest silver vault holder on earth, was positioned perfectly. They didn't panic, they absorbed. They took nearly 80% of the available deliverable supply. In retail, contracts settled in cash, ETFs decoupled from metal, premiums exploded, silver existed. But not for you. And here's the part they never explain on TV. You won't believe the name that signed off on this. Now we go where most people tap out. This is the part they don't explain on television, because once you understand how this machine works, you realize something terrifying. This wasn't chaos. This wasn't incompetence. This was the design. Paper silver, the biggest fraud no one teaches. Let's strip the emotion away for a moment and talk mechanics. The silver market you see quoted every day is not a physical market. It is a derivatives market. More specifically, futures, contracts, options, swaps, unallocated accounts, exchanged traded products, ETPs. All of these are claims on silver, not silver itself. Here's the first shocking number. For every 1 ounce of physical silver available for delivery, there are between 100 and 400 paper claims outstanding. Let that sink in. If this were a bank, it would be illegal. But because it's called a commodities market, it's celebrated as liquidity. This is the fractional reserve system applied to metal, And just like banking, it only works until everyone asks for delivery at the same time. Why delivery is the real weapon on COMEX. When you buy a silver futures contract, you're told you can stand for delivery. But what they don't emphasize is this. The system is built so you don't. Here's how they stop you. Margin pressure. They raise margin requirements suddenly. Retail can't afford to hold. Rollover incentives. They offer cash bonuses to roll contracts forward. Cash settlement. They quietly change contract language to allow cash instead of metal. Psychological warfare. Media screams volatility, risk, and collapse. And most people fold, but sometimes someone doesn't. That's where things break. Deutsche Bank's fatal position. By the late 2010s, Deutsche Bank was drowning. Trillions in derivatives, exposure, weak capital-based regulatory heat from multiple continents. And buried inside that mess, a massive silver derivatives book. Deutsche was short silver, acting as a market maker. Deeply embedded in unallocated silver programs. Meaning, they owed silver they never intended to deliver. They were betting on eternal rollover. But something changed. The delivery event they never planned for. At a critical moment, multiple large players stood for delivery. Not retail, not Reddit, not YouTube silverbugs. Institutional players, sovereign scale players. This is when Deutsche was forced into the corner. They had two choices. Default, openly deliver quietly. They chose option 2. Roughly 3 million ounces of physical silver were forced out of Deutsche-linked channels. That metal didn't hit the open market. It went somewhere. And that's where JP Morgan enters the frame. JP Morgan is not just another bullion bank. It is the largest silver vault operator on Earth, the dominant COMEX custodian, a derivatives dealer with regulatory immunity. Here's a number that should make your stomach turn. JP Morgan controls or influences over 600 million ounces of physical silver across registered and eligible vaults. That's not speculation, that's inventory data. Now connect the dots. When Deutsche delivered, JP Morgan absorbed. When others panicked, JP Morgan accumulated. When prices stayed flat, JP Morgan smiled. Because price is not their objective, control is. Here's a brutal truth. If silver traded freely, fiat currencies would collapse. Bond markets would implode. Central banks would lose narrative control. Silver rising is not bullish. Silver rising is systemic alarm. So banks suppress price using high-frequency trading, spoofing, documented, fined, admitted, naked short selling. Coordinated futures dumps during illiquid hours. Sound familiar? JP Morgan alone paid over $900 million in fines for precious metals manipulation. And nothing changed. Because the fines were a cost of doing business, less than the profit earned never accompanied by jail time. Moral hazard became policy. Now let's talk about you, the retail investor. You were encouraged to buy SLV paper ETFs, silver exposure, mining stocks instead of metal. Why? Because none of those require physical delivery. Here's the key number. Over 90% of retail silver exposure is non-deliverable, which means you can be right, you can time it perfectly, and still get nothing. When stress hits, they settle in cash. When premiums explode, you're locked out. When vaults drain, you're holding a claim on air. This isn't accidental. This is how retail is neutralized. Then came the stress test. Supply chains froze, mints shut down, demand exploded. Silver Eagle premiums went from $2 over spot to $10 to 15 to 20 plus. But spot price? Barely moved. That was your warning. Physical and paper decoupled. And when that happens, it means the price is lying. In March 2020 alone, COMEX registered silver inventories dropped over 30%. That metal didn't come back. It went east. It went into vaults. It went into hands that don't sell. Because this isn't retail versus banks. This is bank versus bank. This is weak banks being sacrificed, strong banks consolidating. Regulators looking the other way. Deutsche lost. JP Morgan won. Retail wasn't even on the board. And the war isn't over. It's just entering the endgame. Here's the part no one wants to say out loud. The next time physical delivery fails, it won't be quiet. The system is faster, more leveraged, more interconnected. In 2008, derivatives were tied to houses. Today, they're tied to everything. Energy, metals, food, currency. And silver sits at the intersection of trust. When it breaks, confidence breaks. And when confidence breaks, systems fall. The tragedy? The warning signs were visible, but denial is comfortable. It feels safer to believe. They've fixed it. They won't let it happen again. This time is different. It never is. The institutions you're told to trust are built on borrowed time. And borrowed time always runs out. So I'll leave you with this. If silver were irrelevant, They wouldn't fight so hard to control it if retail didn't matter. They wouldn't work so hard to erase you. And if this wasn't happening, you wouldn't feel it in your wallet every day. So ask yourself, are we wiser now, or just walking the same path in better suits? If this opened your eyes, share it. If this made you uncomfortable, good. And if you want the truth before it's too late, subscribe, because silence is how this wins. Every engineered collapse looks the same at the beginning. Nothing happens, no alarms, no breaking news banners, no emergency press conference, just policy changes, rule updates, settlement flexibility, temporary measures that never go away. This is how resets are done now, not with tanks, with paperwork. And silver, suppressed, cornered, drained, is the canary. Because silver doesn't just tell you about inflation. Silver tells you who is lying. The first phase of the endgame is psychological. You train the public to accept things that would once have been unthinkable. Temporary cash settlement, exceptional delivery delays, unprecedented volatility, orderly market dysfunction. Language matters. Because once failure is framed as normal, it stops being news. When silver contracts don't deliver, it's just mechanics. When do ETFs decouple? Tracking error? When premiums explode? Supply chain issues. Sound familiar? This is how default is rebranded as functionality. Next, you quietly close the exits. Not all at once, not obviously, one by one. Retail delivery minimums increase, vaulting fees rise, reporting requirements tighten, dealer inventories dry up. Physical silver still exists, but not for you. And when access becomes inconvenient enough, most people stop trying. This is how ownership ends without confiscation. This is where the strong eat the weak. Banks with regulatory protection, preferred access, central bank backstops. Absorb everything, not because they love silver, but because they understand what comes next. Silver isn't being accumulated for profit. It's being accumulated for settlement. Because when trust collapses, something has to settle the bill. Now we connect the final dots. While physical silver is disappearing, governments are racing to roll out central bank digital currencies, programmable money, expiration-based savings, permissioned spending. This is not a coincidence. This is a replacement. The old system, based on trust, paper, and promises, is breaking. The new system requires total visibility, total control, zero alternatives. And silver is an alternative. That makes it a threat. Let's be brutally honest. If silver were repriced honestly, fiat credibility would die overnight. Bond markets would implode. Pension funds would vaporize. Governments would lose narrative control. Silver isn't just a metal, it's a referendum in debt, on discipline, on truth. And that referendum has already been held. They just don't like the result. So they suppress, they delay, they consolidate. Until the transition is complete. This is the mistake most people make. They're waiting for a crash, a panic, a Lehman moment that already happened. The next reset is administrative. It happens through new settlement rules, new currencies, new definitions of ownership. One morning you wake up, and the world works differently, not because something broke, but because something was replaced. Here's the hardest truth of all. The system doesn't collapse because people don't see it. It collapses because people refuse to accept it. Denial is comforting. Denial is social. Denial is rewarded, until it isn't. History doesn't punish ignorance. It punishes willful blindness. So what is the permanent damage? Here it is, the real big reveal, now fully earned. Once physical silver is fully absorbed by protected institutions, the public permanently loses access to an independent store of value. From that moment on, every future crisis is settled on the system's terms. Not yours, no reset button, no opt-out, no hedge, just compliance. If this sounds extreme, ask yourself why it feels uncomfortable. Truth usually does. Because if nothing was wrong, this level of control wouldn't be necessary. If silver didn't matter, it wouldn't be hoarded. If the system was stable, it wouldn't fear delivery. You're not watching a market. You're watching a transition. And transitions don't ask permission. So I'll ask you one last time and really think before you answer, are we wiser now or just walking the same path in better suits? If this made you pause, share it. If this made you angry, good. If this made you think, you're already ahead. Subscribe for the truth they won't package politely. Because silence is how this ends, and awareness is the only thing that ever stopped it.